All right, ladies and gentlemen, it's your host, Aaron Fragnito, here with another episode of the weekly real estate news briefing. I'm going to share my screen. We're going to jump into three top news stories that I think are quite applicable to today's market, today's real estate investors. And this is a 30-minute show we do every Wednesday at 12 noon Eastern time. And this is a show for real estate investors or wannabe real estate investors by real estate investors. Okay, this gives a perspective on the real estate market from a landlord, property owner perspective, and we focus on topics and articles that are going to affect real estate owners and investors. Here at People's Capital Group, we focus on buying real estate in New Jersey. We're also opening up to a few other markets recently that we'll learn more about if you follow us on social media. You can learn more about People's Capital Group on our website, peoplescapitalgroup.com. We also have a YouTube channel and a podcast called the Passive Cash Flow Podcast. But I'm your host, Aaron Fragnito. You can see my screen here. We're going to break right into it. We're going to talk about this first news article, the future of commercial real estate in a COVID-19 world. So here we go. This is just published yesterday. There is no doubt that COVID-19 will affect the future of commercial real estate in New Jersey, but the question is to what degree? Article reads, many of us, the days of commuting into Midtown Manhattan or to a New Jersey suburb office park for work seems like a lifetime ago. But what does the digitalization of the workforce mean for companies looking to lease office space? Article goes on here. Office leasing is not dead in any way. Timothy Grainer, Executive Managing Director of JLL, said today at a Choose New York webinar that explored COVID-19's impact on the state's commercial real estate market. We have been fortunate to see that the bigger deals still close, Grainer said. What has been common with a lot of the transactions we are seeing is that they have been short-term. Temporary office commitments predominantly close to executives' home who don't want to commute into the city. Short-term leases allow companies to see what the return to normalcy would look like 2 or 3 years down the road, in turn afford themselves the ability to recesses. Companies don't want to commit significant capital in this environment, Grainer said. Nobody wants to make a 10 to 15-year commitment until they get the sense of where this ends up. In the terms of office occupancy, John Sorrentino, president and CEO of ONYX, said that they will take some time to fully bounce back. He goes on to say it is going to end up being at least a 12-month process. We are still in some degree of limited occupancy in office buildings pre-vaccine, Sorrentino said. Where will the workforce end up? Well, the idea that the graduates of college today are going to work in the suburbs for the rest of their lives and drive cars to work every day is not something that I see happening, Sorrentino said. Employees drive the decision makers' plans and decisions, and provided we get past the moment, there will be a pivot back to urban environments that I think the younger populace will still adapt to and be part of their lives. It's very interesting because we do focus on investing in urban in cities here in New Jersey, and we're also investing in the suburbs as well, where we see a lot of demand. But people from Manhattan are coming out to New Jersey cities. We see that. The article goes on here. Sorrentino cites Facebook as an example of a company that is leading the charge or telling people to work from home through the end of 2021, while at the same time signing an 8,000 square foot 15-year lease in New York City. That's contradictory. It tells you that Facebook recognizes the long term, there's still a need and demand for office in an urban environment for their employees base, he said. If the talent continues to migrate west into the suburbs, then employees will follow, but I think they are always going to keep a toehold in places that give them the best access and to the most labor and the best labor pool, Greenier said. I think places like Newark that you can both drive to and have Manhattan access will thrive in this marketplace. He said it, not me. I'm a big Newark guy, big Newark investor. I made my first million in real estate in Newark, New Jersey. I breezed through this article earlier today, and I said this article is spot on with where our thought process is and what we're seeing as well. Newark is a more affordable city to live in than Hoboken or Bergen County or Manhattan. So there's a huge demand to move to more affordable cities where you can still commute into Manhattan in less than an hour. And we've seen that for years, and that continues through this tough time. The article continues here. He added, Clients see urban New Jersey as a great place to have an outpost to attract labor and feels that suburban New Jersey is poised to do well in the coming months and years. That's good for us. Chris Palladino, president of DEFCO, said that he is seeing people become more innovative in their desires amid the pandemic. We have had individuals and companies say, I have to get out of my house. Can I rent a hotel room for several days or weeks or a conference room in the hotel? You're starting to see people become a little itchy and looking to do innovative things, Palladino said. I'll stop there for a second. We see the same thing for our Airbnbs up in New England. People are just trying to get away for the weekend. Maybe it's 4 days or 3 days. It's nice to get out to the mountains, get some fresh air. You know, working from home, you can work from anywhere. So a lot of people are renting our Airbnbs out in rural New England, and we're actually doubling down on some of those investments as well. If you want to learn more about that, you can contact us at peoplescapitalgroup.com. Let's get back into the article here. He added that in New Brunswick, he has seen fraternity houses and off-campus housing still fill up around Rutgers University, despite the school conducting predominantly digital classes for the upcoming semester. Students are going to do the online classes from their apartments, and they are probably going to get great customers for the surrounding restaurants with takeout and outdoor dining, Palladino said. The one bright light that I have seen come out of this entire mess from a business standpoint is that every restaurateur that I've spoken to in New Brunswick has said that this is the best summer that they have ever had. People don't usually come to New Brunswick in the summer to have dinner, but with people not traveling far, this has been a unique result of a relatively trying situation. Okay, so interesting article there, really highlights a lot of thoughts that I've had in the past that, Manhattan's overpriced, it's too congested, the boroughs are too congested, and there's been a big push to move to the suburbs of New Jersey and inner city areas in New Jersey where housing is more affordable. You can still commute to Manhattan in less than an hour. We've seen that trend for years, and we see that continue to build here during this tough time. So let's break into our second article. We do 3 articles here at the weekly real estate news briefing, where we focus on articles that will affect landlords. This is a news briefing by landlords, for landlords, by property owners, for property owners, or wannabe real estate investors. So listen in here on our second article. Here's this topic, the title. Driven by low inventory, median U.S. home prices reach record high in July. So you may have seen this article, but I want to reiterate it. It's a short article here. I'm going to breeze through it. California sees 50% drop in listings over the last year. Wow, big note there. The national average median home price reached a new high in July due to low inventory and pent-up demand. We see that ourselves. It's hard to get a good deal right now, especially in high-demand markets like Jersey. According to the Realtor.com, Realtor.com's housing recovery index, the new median price is $349,000, with a list price growth increasing $27,000 or 8.5% year over year. That's a big number year over year. The coronavirus has impacted every corner of the U.S. market, but it hasn't hit every area equally or at the same time, said Realtor.com chief economist Daniel Hale. The U.S. housing market performance is closely mirroring COVID's path, which is providing clues into what we can expect for various housing markets in months to come. After being particularly hard hit in March and April, new coronavirus cases remain stable in the Northeast, and we're seeing buyers return to the market in force. Hooray! Hale said, if this is the same trend follows in the South and Midwest, where outbreaks continue to rise, we could see a flurry of activity well into fall, especially as schools delay their openings. Out of the 50 largest metros, 48 had year-over-year median list price gains in July, up from 46 metros in June. The 2 metros that actually saw declines in median list price were Miami, Fort Lauderdale, West Palm Beach, Florida, at negative 1.5%, and Orlando, Kissimmee, Sanford, Florida, at negative 0.9%. Notably, Florida has been severely impacted by the spread of COVID-19. The number of new listings was down 13.4%. Wow, it's a big number year over year in July, but that represents a significant recovery from the 44.1% drop in April. Whew, that means no one listed their home in April. I don't blame them. Only the Northeast saw a slight decline in listings at a drop of just 1.2%. Yeah, Northeast, way to stay strong. While new listings were down 10% in the West, 16.1% in the South, and 20.8% in the Midwest, nationwide inventory sank 34.48% year over year in July, worsening from June's decline at 26.5%. Okay. So we do have a lot less inventory than we had last year. And that continues to be an issue in all these markets. Article goes on to say none of the MetroRealtor.com tracks had an increase in inventory. The Riverside, San Bernardino, Ontario, California, San Bernardino, Ontario, California Metro saw the largest drop in inventory at negative 50.4% over the last year. Wow. While Baltimore, Columbia, Townsend, Maryland had a negative 48% drop. The Providence, Warwick, Massachusetts, Rhode Island, Massachusetts had a negative 40%, weren't far behind. So the real problem is people are not listing their homes. There's not enough inventory on the market, and that is keeping prices up, and that's perking prices up. I do think as the maybe a vaccine comes out for the COVID, or we make more progress with the quote COVID, and there is more of an indication of a light at the end of the tunnel, as we learn more and more every day, we're not too far away from that, then you're going to see more people list their home for sale. Now, the problem with that, of course, is if more people list their home for sale, well, the challenges are going to be that we're going to run into a large amount of real estate on the market, and that's going to be a challenge for home prices that might suffer at that point. So anyway, let's break into our final story here. UWM is now offering 15-year fixed mortgage rates as low as 1.875. It's a record low interest rate. Okay, that's incredible. The story was updated post-publication, include additional information. Okay, mortgage rates for 15-year fixed currently sit at approximately 2.5%. However, customers of the nation's second biggest lender could soon receive an interest rate below 2%. Wow, below 2%. If you don't own a home and you qualify to own a home, look at this. Listen to this article. The United Wholesale Mortgage. I don't even know who they are. Never worked with them, but apparently they're the second biggest lender. Oh, I've heard of them actually. Yeah, I've heard of them. Okay, United Wholesale Mortgage announced Friday that is rolling out a new loan program that offers borrowers an interest rate as low as 1.875% for both purchase mortgages and refinances. A record low. That's crazy. That's crazy. If you don't own a home, go buy a home. Buy a home today. UWM is both the nation's biggest purchase mortgage lender and the largest wholesaler lender. That means they buy other lends. Oh, here it goes to explain that, meaning it doesn't lend directly to borrowers. UWM works directly with mortgage brokers who can in turn offer low rates to their customers. They charge a couple points. United Wholesale Mortgage is proud to provide some of the best rates, services, and technology to borrowers exclusively through independent mortgage brokers while closing loans in 15 days or less. Believe that when I see it, said Matt Ishbia, president and CEO. We're proud to offer great rates for borrowers for 15-year mortgages, just like we have been on our 30-year mortgages as well. Okay, 15-year mortgage is good. That does mean you pay a little bit more per month, but you're going to pay down your principal faster and have a 15-year debt over 30-year, which is always better. Those eligible for conventional mortgages are eligible for the rate, according to Ishbia. The minimum FICO score is 640, the company said. Okay, so that's not that hard. If you have bad credit, you can get your credit fixed up with a little bit of effort, and you can get that 640 pretty quickly. I had a friend who had a 540 credit score, and in about 4 and 5 months with working with a basic credit repair company, he was able to get that up to a 640. Now they're able to qualify for a loan. So in May, UWM rolled out a new loan program that offered borrowers an interest rate as low as 2.5%, both purchase mortgages and refinances. Then in June, UWM announced a new VA loan program that offered borrowers a mortgage rate as low as 2.25, both purchases and refinances. So really incredible here. If you're working with a mortgage broker that has access to United Wholesale Mortgage, look into this 1.875. You can do it for purchase of homes. You can do it for refinances of homes. The problem is you probably have to put the property in your name. That doesn't work for real estate investors because you should buy real estate in an LLC or a corporation of some type, especially if you have partners and investors. So because of that, since we buy properties in LLCs, we don't quite qualify for these amazing low rates. These low rates are for primary owner occupants, but if you don't own a home and you want to become a real estate investor, go buy a duplex, buy a triplex, buy up to 4 units, and you can lease out the units lock in an incredibly low interest rate, historically the lowest interest rates we've seen ever, and own a home. And you can become a real estate owner. Hell, you can put down 3.5% and with an FHA loan, be an owner occupant. And if you have good enough credit and you qualify here, you're looking at a 1.875 interest rate. That's practically the price of inflation. Meaning that if you buy real estate and it follows the rate of inflation, let's say inflation's 1.875%, the value of your real estate will just naturally grow as long as you maintain it at the rate of your mortgage, of the cost of money. Okay, so the value of your real estate's growing at the interest cost of your money borrowed to buy the real estate. Therefore, the growth in your real estate value, the natural growth due to inflation. Okay, let's say the market you buy in doesn't even grow. Let's say the rents you buy, you're collecting don't even grow. Okay, fine. We don't know. We don't have a crystal ball. But just inflation alone, if that's moving at around 1 to 2%, which it historically does, then you're literally paying interest, which is instantly made up by the growth in your real estate value. So they kind of cancel each other out. So getting an interest rate this low, that's almost equal to the rate of inflation, which is an unpredictable thing, of course. But if inflation stays around the mid 1s to 2%, then it's crazy that you're really kind of getting free money in a way. It's almost free money. You're almost not paying for that interest. I mean, you obviously are paying a mortgage payment every month, but at the end of the day, if your real estate value naturally grows through inflation at the same or better rate than your interest rate on your mortgage, then they essentially almost cancel each other out. That's one way to look at it. And that's the magic of real estate. That's the magic of these low rates. Put down 3.5%. You buy a $300,000 duplex, something like that. That's the down payment's about $11,000 or so. Then you have another $10,000 in closing costs, let's say. So $20,000 or so gets you in on a property. Well, New Jersey rent is about $2,000 a month to live in a decent area. So right there, that's 1 year of rent. You put that down, you buy a home, boom, you own a home. You get tax write-offs. If it's a multifamily property, you can collect rent, so you don't have to even pay those costs to live there. And now you've eliminated your housing costs by buying a multifamily property, by owning it and putting in your name, which is not always suggested, but you do get a great rate for that. Now, if you go out and buy a bunch more real estate, you would want to put it in an LLC and protect yourself. But getting started, your primary residence, make it a multifamily home. You can get up to 4 units for an FHA loan. You can lock in this amazing rate. It's a better time than ever. Prices are going up on real estate. There's not a lot of inventory. But a lot of people say, let me wait for prices to come down. And I've heard people saying that for about 5 years. Okay. And if you looked at the price of real estate 5 years ago, those people saying, let me wait to buy real estate till prices come down. Well, they've been waiting a long time and they're going to continue to wait. Prices go up, prices go down, but real estate, if you buy in the right markets, does hold its value over time as long as it's well maintained. And you want to look at properties in those markets that are holding their value over time and look at locking in this incredible interest rate to own your own home and become a real estate investor, start collecting rents, covering your housing costs, and being able to live for free. Eliminate that housing cost, which is pretty much everyone's biggest cost is their housing costs. So that's it, everybody, for the real estate news briefing here on Wednesday. I'm your host, Aaron Fragnito. Thank you so much for joining us today. I hope you learned about a few updates here in the real estate market. We focused on new low interest rates. We focused on some brokers' opinions that the market in New Jersey here is going to remain strong. It is remaining strong as people are moving out of New York and the densely populated areas and moving into less populated areas in New Jersey here, even moving into inner city areas in New Jersey where it's just more affordable to live. We do this weekly news briefing every Wednesday at noon. I cover 3 stories that are really prone to real estate investors. This is by real estate investors for real estate investors. If you're not yet a real estate investor, go to peoplescapitalgroup.com and learn more about how we buy apartment buildings with passive investors. And you feel like you may qualify as a passive investor, then fill out a qualification form on our website, and you too can become a real estate investor, passively investing in some of the buildings you see right behind me right now. That's it for now, everybody. It's Aaron Fragnito of People's Capital Group. Our website's peoplescapitalgroup.com. Hope you learned a thing or two. Hope you enjoyed maybe eating lunch while I was talking about real estate news stories. Have a good day. Make it a productive day. We'll be back next week at noon with the weekly real estate news briefing. Don't forget, we have our passive cash flow podcast Fridays at 1. We go live there as well. And we have our YouTube channel called the People's Capital Group YouTube channel, where we have tons of free content. You can check out our videos and listen to me talk about real estate for hours and hours on end. If that's how you'd like to spend your day, do that. Thanks a lot, everybody. Have a good one.